Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain. Thanks for joining us.
That's right. Both myself and my co-host here, we're both financial advisors, certified financial planner, chartered financial consultant. Spend our weekdays meeting with people like yourself and broadcast this program on the weekend. So whether or not you've got a financial advisor you work with or you get your information on your own, we're glad you are part of our program here. And if you want to be a caller, we'd love to take any question you've got. 833-99-WORTH is the number. 833-99-WORTH.
And what we try to do is provide financial peace in people's lives. We like it when people get to retirement and aren't stressed about the idea of retiring and where money's going to come from.
Yes, retirement age, whether or not they choose to fully retire or not, that's to being in a point in life, a position so work is an option and not an obligation, where you've got the financial security so that you can work on your terms.
You can decide.
If you want to work, not want to work. And look, most of us in this country have that opportunity to get to that point.
Yes. Yes. And retirement.
We have to get the kind of skills that the marketplace will pay for. Work hard, save well.
But this whole retirement is a relatively new construct in the history of man. It truly is. It's really come about in about the last 50 years that the average person actually could retire. What would happen 100 years ago, you'd move in with a son or daughter, or your son or daughter would move in with you, and you would, right, live as a family.
Well, when you saw when pension benefits took off, as well as company health insurance, World War II, there was a period of time you were not allowed to increase wages to
salary caps. Yes,
right. And so you're a company, or you want to get some employees. What do? You offer some other benefits, and that's when you saw mass adoption of pension plans
and health insurance.
Right,
which is a way around
unintended consequences.
Unintended consequences
from Congress. Good old Congress back in Washington.
Salary caps. They're like, oh, we can't pay any more than this, but we'd like the best employees. How do we do this? Let's start giving some benefits on this side. Right. They didn't exclude that.
It was the pension from old line companies that really pushed the whole retirement. That was our parents' retirement.
That's right. My grandfather.
Actually, not my parents. My mom had a pension. She worked for Southern California Edison.
My grandfather retired from Westinghouse in Pittsburgh, Pennsylvania, and had a pension. Right, and his parents lived with them when they retired.
That's the difference. There's the generation right there.
Right?
And you have no pension.
And I have no pension.
Yeah. The government workers still have pensions. They're the last ones.
Yeah.
Pretty much.
And some old line telecom.
You don't see any companies coming out with new pensions to find
old line
pension
telecom, electrical, and some healthcare.
But retirement, being in a position where you are financially independent and retirement's a possibility, is still a reality, and for it's still attainable to most Americans.
It's your responsibility, though.
It's your responsibility.
So it's interesting, Scott. When you look at the clients that we meet with, they're normally in their 50s, mid-50s, and
I think the average age of a new client who joins Allworth is 58.4 or something.
But when they start meeting with us, it's in their early 50s, mid-50s is where they'll start meeting a few years before retirement, and they almost all have something the same in common, which is they're concerned about their retirement and they were pretty good savers. And then all of a sudden they get to 50 and the kids are leaving the house and
55,
and all of a sudden they're like, okay, we've been saving all these years. We've been trying to pay down debt. Let's count it all up and see if we can do this thing in the next 3, 4, 5 years. That's what it looks like.
Or 10 years.
Whatever the number is.
Yeah. Get to a point where retirement's a possibility.
Yeah.
But it takes
it doesn't happen by mistake.
No, it does not happen by mistake.
You show me someone that doesn't worry about money, and I'll show you someone that doesn't have any.
And we see those too.
Yes. Yeah.
Like I don't take new clients because I don't have time in my schedule for that. But I just remember years ago when someone would come in, they would have no worries at all about retirement, and the majority of the time they didn't have enough assets. The ones that came in that were highly concerned, well, we're just really worried. We want to retire in 2 years. Not sure we can make it happen. They usually had plenty of assets.
Yes.
Because they were concerned it was been a priority for them since day one.
Yes.
And most people, by the way, that come to retirement with large 401k balances have been saving in their 401k their whole career.
Since they were young. They made it a priority.
Even when their car blew up, when their roof leaked, when all those other
things in life
needs
happen,
they said this is still a high priority for us.
Yes.
Yeah. Anyway, 833-99-WORTH is the number to get you on our program, and we are talking with Ken. Ken, you're with Allworth's Money Matters.
Hi, gentlemen. Thank you for taking my call.
Yeah.
I greatly enjoy your show. I enjoy the banter and the, how should I say this, the change of opinions that both of you have sometimes with some of the callers.
Oh, good. Well, thanks.
So I wanted to ask you a question about,
the thing about financial planning, about being an investor, it's like it's all in the future. So nobody knows the future. It's a combination between a science and an art. It's not like if we're doing some accounting on history, trying to figure out, adding up what happened yesterday. That is science. If we're looking at the future, now it's
statistical probabilities.
Yeah, so that's why
opinion.
we don't always agree.
I heard an financial advisor ad a few weeks ago where he said, come in for an unbiased opinion. And I thought, that's crazy. There's no such thing as an unbiased opinion. By its very nature, an opinion is biased. So we are
definition.
By definition. Right? And I would
they're lying to you already.
And so I would hope our biases are strong.
Yeah. So what's on your mind, Ken?
So I listen to a lot of podcasts about financial matters, and I have a unique situation. I haven't heard this one before, so I thought I would run it past you two and see what you thought. So I'm a diligent saver. I have been, very conservative with my money and also allocations. Through the years, about a dozen years ago, I started to invest in tax-free California municipal bonds. That has ballooned up to the point where the unintended consequences were that it might be enough income that it might provide for what our expenses are for my wife and I.
How old are you?
Throughout a year. I am 54.
Okay.
And so what I've done is I have diligently saved also in a 401k and IRA, and I've maxed out every year for at least 20, 25 years. My thought, and my wife and I are doing this year, we're trying to see if we can stay on budget with just what the muni bond interest pays out per year. My thing is I'd like to retire by 60, so that's only 6 years away, and we're approaching that. And I know that there's return risk, sequence of return risk.
Mm-hmm.
And people say you should get a little bit more conservative, but I think I've already established that. In fact, with this muni bond portfolio is almost like an annuity.
So you have probably 3 or 4 times your annual income in munis, more than that, multiple more than that.
Yeah, you actually. So what is the return coming out of the munis? So here's what scares me is you may have bought a muni 5 years ago that had a 3% tax-free yield on it, but to reinvest today it would be 1 or sub 1. What is the return that's coming out of your muni, a blended return coming out of the munis right now on just the interest payment blended? Forget what the overall return is.
Yeah, so good question. So the overall return on the portfolio is just under 4%, and the average year to maturity is 21 years, and they're all either AA or AA insured. They're very high quality.
So you think that the predictability...
And these are trading at par? I mean, these bonds got to be trading much higher than the par value.
Yeah.
Yeah, there's unrealized gains in the portfolio of about $250,000.
Got it. And so you're confident of this cash flow because the average yield to maturity is 4%. What's the average yield to call?
Well, that's lower than that, but I honestly haven't had many that have been called, even in this interest rate environment. There were some 5% bonds that were called, but everything else has not been called.
So you're using small districts, municipalities, water districts, things like that?
Exactly.
Okay. All right. Okay.
So
sounds like look, and I think for the rest of you who are listening, like if you do the kind of work that Ken puts into his financial planning, then you too can build a mini portfolio.
Yeah.
But if you don't, then don't try to duplicate what he's doing.
So for a lot of you listening, we might as well be talking a foreign language: yield to call, yield to maturity. So what's your question for us?
So I have in my retirement accounts approximately, my wife and I, when I say I mean my wife and I, about $3 million.
Okay.
And it's for the most part invested all in equities.
Great.
And I know that the standard answer is, well, as you get closer to retirement, which is only 6 years away from me, you should really go into more bonds. But I already have that in a separate portfolio.
And what do you have in the munis? What's that? About $5 million?
No. It's 3.4 that I put in. That's the cost basis. And unrealized, as I said, is another 250 beyond that.
Okay,
so you half your
365.
portfolio's outside of retirement account in munis, and the other half are in retirement accounts and equities.
Yeah. So what's your question?
So my thought is I don't really need to go conservative on the retirement
100%
account.
agree.
I can just leave it.
100%
Absolutely. Absolutely.
I don't want, and this is why the primary question here is if I let it ride, and I don't necessarily want to go all the way to 72 before I start taking funds out of the retirement account.
That's right.
Then I have a tax time bomb.
That's right. That's right. You want to start as soon as you retire, pulling money out of that.
Correct.
Of the 401k and IRAs.
But
Absolutely.
here's one way to think about it. And here's what you're thinking. I'm all equities. I go to retire. It's going to make sense for me to take 50 grand, 100 grand, whatever the number is, out of my 401k. But the market's down at that point. Bad time to sell.
I don't have to.
Yeah, you don't have to. But you get rid of this.
You can also say, I'm going to take 100 grand out of my 401k. I'm going to sell the total stock market index or whatever you own. And the same day, I'm going to go buy that on the outside so that I actually have not decreased my equities. I haven't sold in a down market. So you have that flexibility to do that.
And not have to worry about sequence of return events.
That's correct.
Right. And that's my whole thing. I just want to see and ask your opinion on sequence of returns. And if I could take out money and maybe up to the 22%.
Maybe higher.
You want taking out money now?
No, when he
no. When I turn 60.
Yeah, or probably convert it to a Roth.
Listen, and first of all,
Ken,
probably
convert to a Roth.
Most likely you'd convert to Roth, and you're a dreamer if you believe that the tax rates are going to stay the same 6 years from now.
Well, yeah, I know that. I know there's a sunset provision for 2026, but the other thing is I live in California, so I don't know if I want to convert to Roth while I'm still here. I do plan on getting a place outside, so I don't know if it really makes sense.
Probably. Yep. Well, if you plan on, well, then it might not make sense to take a withdrawal either.
Yeah,
I wouldn't worry. I wouldn't worry about 6 years today. I think you're being very prudent in your planning. And I think these are the right questions to be asking. I'm 54. My 401k is 100% equities. And I think it'll always be 100% equities. I'm
58, 100% equities.
And my portfolio, it's not everything I own. I'm highly diversified. I have lots of things. But my 401k is 100% equities. And I think yours should be as well.
Yeah, and actually, I would make the argument that you're actually don't have enough equities in your portfolio, but you're comfortable, and you obviously got to $6.6 million without my help. So do what you want.
Okay, so you guys don't see any other changes you would do?
I would not. Look, here's what I mean. Look,
you're a rock star.
Yeah. Would it be the exact way I would construct things? Maybe, maybe not, but it's a great strategy, and it's worked well for you. You understand it.
And I assume you don't have any debt.
I have no debt.
And I assume you probably have some real estate outside of this.
I do have some rentals.
There we go. You go.
Well, let me ask you, what's your annual income? Ballpark, wage, your salary, employment, whatever.
It varies from 150 to 300.
Yeah.
Okay,
So
here's someone who makes 150 to 300,000. By mid 50s, he's got a net worth of $9 million.
$9 million. Yep.
300 grand in his 401ks.
$3 million. $3 million.
$3 million. You got there because you were very disciplined in your savings over the years. You talked already about budget. Can we make it on our budget?
Well, we've never done it because, so as I said, we're trying it out because.
Yeah, you do. You don't spend more than you spend. You live below your means.
Listen, Ken, I have belonged to a gym for 25 years with the idea that I'm going to go 4 days a week. I've never done it, but I didn't quit the gym.
I don't think you can try to live on a budget now if you want. You're going to be fine at retirement. If you quit today, you'd be fine. So I wouldn't. I don't think you need to go through.
What I think you need to do, Ken, is to take a copy of this podcast and replay it for your wife, just so she could appreciate you more.
Appreciate you even more.
Even more.
Self-promotion.
You've done a great job. Congratulations.
Yeah.
You should be proud.
I think you're in great shape. I don't think I'd change anything.
I wouldn't change a thing.
Okay.
Well, I may have said that.
Yeah.
I wouldn't be contributing a 401k on a pre-tax basis.
You plan on leaving the state of California?
I would contribute on a pre-tax basis.
Well, here's what I've changed up this year. I've changed up my salary because I'm self-employed, and I'm going strictly to Roth 401k.
Okay.
How many employees do you have?
It's just my wife and I.
And
So solo K.
you've set up a solo K.
Yeah.
Yeah, it is probably.
Pretty much, yeah. And if our income gets high, I can always open up a defined benefit.
How long has your
plan.
wife been working with you?
Honestly, I just put her on payroll recently. It's usually been just me.
Because why?
She's been a homemaker. We have 3 kids. They're older now.
Does she
And
qualify
so
for?
now-
Does she qualify for Social Security already?
Yeah, does she have 40 quarters already?
No, she's probably when Social Security comes around, she'll probably draw half of mine.
So that's a question that I would actually, that is one thing that I would actually dig into, whether
It makes sense.
it
having
makes
her
sense
on
to have
salary.
her on because of the caps withholdings on Social Security.
Sometimes I see people add a spouse so they can contribute to their retirement plan for the spouse, but what they end up paying more in FICA taxes negates the
Correct.
benefits.
Because your 401k is tax deferral, putting money into Social Security, and you get to do it kind of electively, is different. So that's one. I'd circle back with an advisor or an accountant, and that's one thing I would question.
That's the one thing I'd look at.
That's one thing.
Other than that, I think you're doing a fantastic job.
Well,
And if
her
everyone was
entire
like you, I would be
salary-
out of business. So.
Her entire salary is going to the Roth 401k. I pay her about
understand, but you're still paying Social Security tax on that.
15.3%.
But it's not really 15.3 because he would have had to pay on the Medicare of 2.7.
2.9.
Sorry, 2.9.
So it's not. It's 15.3.
So
minus
it's 12. Yeah, it's 12.4.
That's right.
And the question
You're
is,
paying 12.4%.
You're paying 12.4 over the
for the
limit
privilege of the Roth.
for the privilege of the Roth, and we don't know if it's worth that 12.4% to put the money in the Roth. You might be better off paying taxes on it, putting it in an S&P 500 fund, and letting it grow tax efficient rather than 100% tax deferred.
Okay, good point. All right.
All right, excellent point,
All right.
by the way.
Good. Ken's like, I found something. Good. I'm glad I called.
I didn't waste my time here.
Yeah,
Thank you,
he
guys.
didn't just
I
need a pat on the back, right? He's like,
Look at
I
me.
found something. I found something I could.
All right, appreciate
No,
that.
I was joking. I mean, if everyone were like Ken, there would.
You wouldn't need help, guys like
I
us.
couldn't help. I
Well,
wouldn't.
although we did help him some.
But I would. I mean, most people don't take the amount of time. Obviously, he's very passionate about what he does here. Let's continue on with calls. We're talking with Kathy. Kathy, you're with Allworth's Money Matters.
Yeah, hi. Thanks for taking my call. I actually have 2 questions. One's regarding inheriting a Roth IRA, and the other one is I wanted some information on RSUs. So I've been reading about the beneficiary Roth IRAs, and one website says you have to withdraw all the funds within 10 years. And the other website says if you have one of these beneficiary Roth IRAs, you have to withdraw within 5 years.
Yeah, the rules changed.
And it's,
You have up until 10
so
years.
which is it?
You've got 10 years to disperse the money. It used to be you can stretch it out over your life expectancy.
But you have to take it out in the first year.
If you don't take it out in the first, I believe the rule, if you don't take it out in the first year, you've got to take it out within 5 years. You've got to take it. Yeah, that is correct. If you got to take a distribution in the first year, and if you don't, you got to withdraw the whole thing in 5 years.
If you take a distribution in the first year, you can defer it for 10 years. So both websites are correct. It's how you actually
Okay. So you have to
structure it.
start taking within the first year in order to defer,
For
in
10.
order to stretch it
That's
out
right.
at least 10 years.
This is for a
Is it the
non-spousal.
same with the regular?
Non-spousal.
Non-spousal.
Yeah.
Same as an IRA or a 401k.
All the same.
The stretch rules
then
were eliminated.
And you had a question on RSUs, restricted
Yeah.
stock units.
Yeah. So my son was just offered a job that had some of these, and so we were trying to read up on what they are, how they work.
How many did
Basically,
he
yeah,
get?
I'm not exactly sure,
Okay,
but I know it's like a vesting of 4 years or
Yeah,
something
yeah.
like that, where
I
part of them vest every year for 4 years.
Yeah, Kathy, the only thing that you need to know about these things is what are the restrictions to actually take the dollars out and when. I wouldn't put much energy into it until
Because you have
there's no control over it. You can't plan. You might spend hours and hours studying something that isn't in the money a year from now, in which case you wouldn't exercise the restricted stock unit. So I would just
So you mean they're like options,
Yes.
stock options, where they may be worthless?
They could be depending on how the vesting goes, depending on how it's structured. They're all different. Companies structure these differently.
Yeah, so I wouldn't spend any time until I actually had to make the first decision. So you said he just got the job and they don't start vesting for a year. So you
He
want
has nothing yet.
Yeah, so I wouldn't spend a bit of energy. 2 weeks before they vest, I'd see if they were in the money, and if they're in the money, then I'd do some research on it. But I wouldn't do a thing until then. That's just me.
There's nothing you can do.
okay.
What are you going to do?
Well, you could learn about it, but it might not be applicable to you in a year.
Right.
So appreciate the call.
Yeah, it's RSUs are a very common way now for not common. It is more common than stock options, which we saw 20 years ago. I do have one of my kids that I've known. He's 25 now, but I've known him since he was in first grade. Our kids went to school together and close family friends, so I've watched the kid grow up. Year out of college. Yeah, he's just maybe he's a couple years out of college, 3 years out of college, almost 3 years out of college. And the company he works for, he's got these. He had some restricted stock. It's worth a couple $100,000.
Yep.
So I've had some conversations. He every once in a while he'll reach out to me, and because I'm like family, I've known him for so long, and like we were talking about, Scott, should I sell some of these? And I think we decided last time. I think we said let's sell half because his company value just went through the roof.
He went to work for a tech company.
Yeah, it's a tech company.
I had the same conversation with
and it
one
went through the roof, and so we're trying to. It's funny because he's like, "How much should I sell? What if it gets like nobody knows?" Like, and we talked about what happened during the last tech decline. Like, it'll come. Things go through cycles. They don't.
And
go
so
up
what you
straight.
do, you split the difference.
We split the difference. We sold half. So the nice thing about selling half, you're always half right and half wrong,
And
regardless of what you think.
it's a risk mitigation tool. It
100%.
isn't a yield manage. You're not trying to necessarily get the highest yield.
Well, we did look at what revenues the company have, what growth does the company have, how many years would it take them at this growth rate to get to a point where the price seemed even remotely realistic to the potential earnings of this company, and then what's the probability of that company being able to pull that off?
And are they just hot right now because they're in the hot sector where everything is you shine a light on is hot, right? So that's funny, Scott. I had a conversation with a friend of mine. Son, who pretty much the same. I coached the kid in soccer when he was 6. Actually, I remember making him run laps.
It's funny. There's
Elliot,
there's these star managers again, like hot stock pickers. Like, who's this woman now that's...
Oh, yeah. She's on Reddit.
And she does videos every day and stuff. She's got all kinds of... It's all the hot growth tech companies.
Yeah, it was like the Janus funds in the 1990s.
That's exactly what I felt like. Who was the
Janus fund?
Who was the Janus overseas?
yeah.
What was her name? She was hot too. She had a hot hand and was doing extremely well in the market.
It's like
Didn't
it
end
repeats
well.
itself again.
I know. Watch out for these momentum plays.
And King Kong versus Godzilla's back. So we're
and Wonder Woman 1984. I'm confused by the title. Is this are they just taking the movie in 84 and replaying it? I don't know.
Everything is a repeat. Maybe it's because we're just old enough that we remember.
I think so. Hey, we got to take a quick break. Stick around for more Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean.
And if you'd like to join us, 833-99-WORTH is our number, 833-99-WORTH.
And why wouldn't you want to join us? Call's free. In case you've got a phone plan that was started in 1970.
Yes. When you hear advertisements about texting, message and data rates do apply. Like, at what point can a company not say message and data rates do apply? They don't tell you if you call a phone number, might cost you money to have that phone.
I don't.
Don't things like that ever perplex? Like,
well,
I'm thinking about how much of
all the
advertising
cost.
time is wasted on saying message and data rates do apply.
The cost
How much does it cost you to send a text?
I think it's free.
You're unlimited. Yeah,
I don't know.
I'm pretty sure you have an unlimited plan.
I don't know. I'm doing pretty well, Scott. I pretty much text whenever I want now because I'm a hitter. I don't even worry about the cost of a text.
Do you use 2 thumbs or 1?
I just my finger. You know how much my kids text?
My daughter.
Holy smokes!
Yeah, I can't do it like that.
They just all through. So my daughter's teaching at an elementary school, and she communicates.
Are they in person?
Not yet. A couple weeks here.
Safety first. Safety first.
But she communicates with most of the parents via text. And the other teachers were like, oh, the parents never get back to me. I send them emails, they never get back to me. And my daughter's like, it's because that's not how they communicate. They communicate via text. And so my daughter engages these parents through group text where she actually does one text, but it files out to everyone. I'm like, so they have your phone number. She's like, no, they don't have my phone number. I go, well, how do you do this? She said, well, I set up this dummy phone number that acts as a screen so they can't actually get to my real number, but I'm like, this is how technology is going to go.
That.
She does. She's been showing some of the other teachers actually how it works. But you got to go to where, I don't know how we got on this subject, you've got to go to where the people that you want to communicate with, how they communicate, not how you want to communicate.
Let me write that down.
Well, we're starting to use it in our marketing department text.
Well, text, it's funny because text used to be like, is it okay if I text you? Now I get a lot of unsolicited texts that I don't.
I got 2 yesterday.
Don't like those.
I got 2 from nonprofits, political action committees. I'm like, I'm pretty sure you got a wrong number here.
You're not getting a dime from me on that stuff. All right, let's hit back the calls here. Let's talk with Sid. Sid, you're with Allworth's Money Matters. I'm sorry. Let's talk with Rick. Rick, you're with Allworth's Money Matters.
Hello, how you doing?
Hi, Rick.
What can we do for you?
How are you?
We are good.
Okay, this is a tough one, I think. I don't know. My mother-in-law owned a condo, and so some 20 years ago, my brother-in-law had the idea of putting a condo in his name as my wife's name in case something happened to their mother. Well, 20-some years later, she's still kicking, and they had to put her in a assisted living.
So they had to sell the home to pay for it. And now we're probably going to get taxed.
Oh, yes.
On that amount.
That's right.
And it's not that they want to keep the money. I mean, the money's for her, for her care. But the more we pay out in tax and everything, the less money we have for her care. And the way she's going, she's 103, and she ain't going
103.
right now. Yes. And she's healthy as can be.
How long ago did your brother-in-law do this?
He did it like 20-some years ago.
Yeah, that was a bad idea.
Was in their 80s.
What was the value of the house?
It was a very bad.
What was the value of the house then, and what's the value of the house now?
Well, it was valued around $80,000 then, and now it's valued at they sold it for $249,000.
But your cost basis is lower than $80,000 because
That's
it's
right.
actually whatever your mother-in-law's cost basis is.
And so it could be 20. So you might have a $230,000
Let's
capital
call it
gain.
let's call it a $200,000 gain. That's $100,000 that flows through your tax return, and $100,000 that flows through your brother-in-law's tax return.
And capital gains and then state income tax. Is there a way around this, Scott?
The sale's already done, right?
The sale took place?
Yeah. Well, they had to sell it in December.
So
Yeah,
it took
'cause
place.
she was
So
already in
it closed escrow in 2020.
Right. And she's been in the nursing home since like June or July of last year. And all the money, I mean, is in her checking account and goes to her care. So they pay her monthly expenses for the assisted living out of that money.
Yep. And
I mean, they haven't taken a dime and probably won't.
yeah, it was a bad idea. It was some amateur
Now, we've
estate
seen it.
planning. I just don't know if there's a way around. It might make sense for you to reach out to.
What are you going to do? It's 20 years.
Yeah.
It wasn't mom's asset any longer. 20-some years ago,
Yeah.
she gave her condo to her 2 children. They were kind enough to let her live there until she couldn't be there anymore. Now she's not there. They sold it. It's already done.
Yep.
It's sold. There's capital gains to report. There's no way around it.
And she was the only one that lived in the house.
Yes.
Yep.
Yeah, she was the only one, yeah.
Yep.
I mean, you could have structured in December, you could have figured out if there's a way to do an installment sale and sell 50% in December of 2020 and 50% in January of 2021, and you could have split the income out over 2 years. That's what I would have looked at the time.
That's pretty smart, Scott.
And I would have probably only accepted offers that would be willing to accommodate that. But
it's done.
it's a hot real estate market. But it's done.
It's done.
Done, yeah.
Yeah, it's going to cost you probably, I don't know, $25,000.
Depending on what
So is it smarter
state is.
to divide it between the two?
Well,
Well,
it is
yeah,
divided
it
between
is
the
divided.
two.
You don't have any choice.
50-50.
Yeah, right.
Yeah, you don't have any choice in the matter. Yep. Unfortunately,
Yeah.
this is I have seen this, I don't know, a dozen
Yeah.
times. Dozen times. Always after the fact, by the way, because when we see it before the fact, we actually fix it.
Yeah.
So
Sorry, Rick.
appreciate the call.
Yep.
I appreciate it. Thank you, guys.
Which leads me to, on our website, we've got a couple factoids, retirement factoids. One right now is, working with a good advisor can produce up to 3% an additional return. And it goes into some details on it. And
This was a perfect example.
this was a perfect example.
Perfect
It's
example.
this sort of thing that good financial planning can avoid, help you maximize what it is you're trying to accomplish. The idea of and maybe they were trying to artificially impoverish mom in the event that she needed care, so she didn't have the asset any longer. It sounds like she has other money.
Yeah. Yeah, she's in a paid nursing facility. They're taking the money and paying for it. So it didn't sound like she was in some state aid.
And some facilities that don't take state aid.
That's right.
And the facility you might want to stick your mom into, if you've got the resources, might be the one that doesn't accept the state
I
aid.
went through both with my dad. Went through both. The ones that, when he was on Medicare, and then once the Medicare ran out, we moved him to a private, and the differences between those two care facilities was significant. So 3% return.
There's other ways to do things. Yeah. Anyway, look at those studies to show how working with a quality advisor is.
And you go to allworthfinancial.com.
That means not someone who's selling you fixed annuities or
the guy sit in the corner at the bank.
I hear ads. You can always tell an ad when they disclose their insurance license number on the ad. Whether it's a mailer inviting you to dinner. I don't know if it's going out to dinner anymore, but
a retirement without risk. You hear those ones all the time.
But I saw another, and this is a guy that I actually respect, but I don't respect what this particular thing he came out with. Financial advisor, national financial advisor. And they have this program now that it limits your downside protection.
How?
Well, here's what it says. When your portfolio reaches a certain threshold that you set ahead of time, we will sell stocks in order to protect your principal.
Do you think he has that on his own portfolio?
Of course not. That's the opposite. So what it does, if your account balance falls, if the things that you own fall in value, it triggers a sale automatically.
When do you buy it back?
I don't know.
So let's say you had $1 million and you said, okay, my downside threshold is $900,000.
And let's say you were 50% stock, 50% bonds.
It hits $900,000.
20% downturn on the stock market, you're at $900,000 and it'll sell.
Your stocks.
Yeah.
Or assuming, or maybe everything. I don't know. Or maybe there's preset. And then that's easy. Sure, I could do that. I don't need a program to do that. I actually can view my account online and decide that.
But isn't that the opposite thing that most advisors recommend?
Correct. Shouldn't you
You don't sell when they're down.
Well, look at our own portfolios last year when we actually reallocated the portfolios.
We did the opposite. The majority of our clients, those that had retirement assets where there's no tax consequences, it's very easy to do rebalances. Automatic triggers when markets went down, the stock exposure was low, automatically created some trades to buy more stock, not sell when things were down. And when things recovered, the exact opposite took place. Triggers to sell. It's the opposite. Buy low, sell high. I mean,
we were quite proud of our returns we're normally very, very proud of our returns, but last year we were especially proud of our returns relative to the market and the risk and the discipline going in. And what you're describing with this big conglomerate is exactly the opposite.
So to the point that a good advisor can have 3% returns, part of that is the behavioral finance part, that making sure that people keep the investments at the when it's the most painful. And this program seems to be doing just the opposite. I would argue that you're guaranteed to lose money long term in that.
It's not helping you. It's making you feel better.
And I don't know if it's a marketing gimmick. I don't know if they're actually putting many people in this. Maybe it's just let's get the phone to ring, let's have a conversation, then let's put them in something that's the right thing for them.
Yeah. I don't know. I wouldn't do it with my portfolio. And I'm pretty sure
it's also they also do things like it's free up until 10 p.m. this evening. You got to call now. Like there's a limited supply
of what?
Of financial plans or whatever. There's no more. Like we only have 4 left. You know what I mean?
That's a little disingenuous.
Yes.
Yeah.
I don't know. Maybe he's lost his way a bit. Anyway, I'm not going to name who it is, and not going to infer who it might be either. Our contact number to join our program, 833-99-WORTH. 833-999-6784. And let's talk with Craig. Craig, you're with Allworth's Money Matters.
Hi, how are you today?
Good. How you doing, Craig?
Pretty good. My question regards around rental properties. I currently have 2, and in addition to my primary residence, of course. And as you know, cost of real estate's been going up and up and up and up. And I would like to acquire another one.
I thought you were going to tell me you were going to sell one, but no, go ahead.
No. I've been doing this for about 30 years, and it's worked out pretty good for me. So the problem is that first of all, the reason I want to buy another one is because I have a lot of cash sitting around, and obviously it's not earning me a heck of a lot. I've got money in the stock market via 401, 457s, and traditional IRAs, in addition to a regular account. So I'm trying to figure out how to best utilize my cash without tying it all up, and at the same time get a better return than what I'm getting on it just cash.
And is your primary home paid off?
I owe. It's worth about $700, and I think I owe about $215 or so.
And what's the interest rate?
Refinanced it. It's 2.6 something.
Okay, and tell me about property rental number 1. What's that worth?
Property rental number 1. That's my oldest. It's worth about $350.
What do you owe?
I owe nothing on it.
Okay.
Property number 2. I just
Craig, when did you buy that? What year did you buy the rental number 1?
1984.
Okay.
And property number 2, I purchased that one in 2008. Just recently refinanced down to about 3.1, and the mortgage balance on that is about $215, and I think it's worth about $550.
What'd you pay for that?
$315.
And what's it worth today?
$550.
Oh, that's right.
That one. Yeah, about $550.
And you bought it at the beginning of 2008, or
the end of 2008,
or the beginning of 2008, or the end?
It was at the beginning. It was before the bottom.
Oh,
but I bought it at a good time.
Yeah.
All right. So here's one.
And how much? So how much do you have in savings in the bank?
Total cash, I got about $500,000.
And how old are you?
I'm 60.
And how did you accumulate the $500,000 in savings?
I worked very, very, very hard and very long hours.
You bought your first house when you were 24?
Actually, I was 23, yeah.
Were you in college?
No. I was in the Air Force at that time. I didn't go to college until about 3 years ago.
Good for you.
Wow.
Savings. And how much did you say you had in your 401k?
I have 457s.
All your retirement accounts.
I have TSPs.
Yeah, all of it.
All of the retirement, about $500,000.
And then $500,000 in savings in addition to that.
Right.
And will you have a pension at retirement?
Yeah, I have. So I retired 10 years ago, and then I got tired of retirement. I went back to school, and then I went back to work, and now I'm working full time again.
For a state, government, municipality, private industry?
I retired from the state. Well, first I retired. First I got a military retirement. Then I went and worked for the state, and I got a state retirement, a peace officer retirement. And now I work for the federal government.
Of course you do.
Good for you.
Because you can. You think you could dip twice more before you completely retire? So here's an observation I would have made. I think the mistake you made in this thing is when you refinanced your home, you should have actually taken more cash off and paid off rental number 2. Just because the cost of money was significant.
Yeah, but I could also make the argument that he's not getting much of a tax break. Well, you can still itemize your. Yeah, you can still take your. Never mind. I retract that.
Yeah, so that's just kind of a gap.
The 6. It's not much.
But it's not that the big a deal. That's around the edges.
So what do you? I mean, clearly, what you don't want to go another year with $500,000 in the bank earning nothing.
Right.
And $430,000 in mortgages paying somewhere between 2.6 and 3.1.
Oh, right.
You ask me why he wouldn't?
My perspective is that interest rates. I don't see them going anywhere except up. I don't see inflation going anywhere except up. So I think that the cost of that money is ultimately going to be smaller and smaller.
I get you.
So,
But you know that it would be foolish for the next decade, let's say. You asked me about 1 year, maybe let's be opportunistic. I think that's where you're going to go with that, bet.
Correct.
We've been working together a long time. But for the next decade, you don't want to go the next decade with cash in the bank at low interest rates and
You're
mortgage low interest rates.
60.
exactly.
You're
Yeah,
60. You're set. You're done.
Financially.
You're finished.
What do you mean you're done? You're finished? Who wants to be told you're done and finished?
Financially, you're secure.
You've reached the point where you've got financial security.
And see, that's part of the problem because the thing is I'm kind of like an overachiever.
You're done.
I mean,
You're
the thing
finished.
is
You're done. Didn't you hear Pat? Craig, you're
yeah,
finished.
I know, but
That's what he said to you. You're finished. Okay? I'm sorry.
Did that come off a little
That's what
coarse?
it sounded like. It sounded
You're
like you were
finished.
putting them
Why are
out
you
some-
talking to me?
You'll never work in this town again. That's what it sounded like, right?
It's a little coarse.
I don't think he meant it that way, obviously.
I'm hungry.
He meant it from a financial perspective, you're set. Now, what's your perspective on that?
well, yeah, and that's part of the problem but the thing is I like to keep. I like my money to keep working. I have a young son. He's 11, and I've got his college set and paid for. So I don't really need to think about that. We have a nice house. We're really comfortable where we're at. I don't know. I suppose.
Do you want another
we could
rental?
travel more.
So I'm
Yeah,
being
I do.
totally transparent. I'm in the process of getting rid of a rental home that I have. Mainly, not because I don't think it's going to do well the next 10, 20 years. For me, it's like one more thing to deal with. And it's not, whatever it does in the future is not going to have any impact on my standard of living, but it takes time from me, and it's not my favorite thing to deal with.
So let's go to the other perspective. I don't know at these prices how a rental would actually not go negative at these prices.
What do you mean not go negative?
Like negative cash flow, depending upon how
Well,
much
he
money
can
you
buy-
put.
he can buy one in cash,
how much money
$500,000.
you put down versus paying down those mortgages.
Well, he can go take $400,000 of it and buy a rental somewhere.
I get that.
Or
I get that.
Go somewhere else and buy a couple rentals.
Which is
You
probably
go to Detroit, you can buy a whole city block.
Don't think I'd want to buy a rental in Detroit. But that's another story.
I know.
I don't see anything wrong with that. I mean, just you're going to recognize the risk in terms of where you're buying in the market cycle.
Yeah, we don't. I mean, the market real estate prices might go up another 30% before.
It certainly feels different this time
Well,
It's
versus
totally
08.
different this time. It's a real supply-demand issue this time. The last time it was all based upon these liar loans and easy money.
Artificial cost of capital.
So from what I gathered that I hear you saying is that, and that's the thing we're experiencing in Sacramento. I think there's 4 offers for every one listing.
Not just in Sacramento.
Which
Yeah, the cold country.
yeah,
Except for Detroit.
and so the thing is I know that the value of the house is going to go up. But I've always approached this from a what is my cash flow, my net cash flow per month.
That's right. That's the discussion.
That's
positive enough so that it justifies the effort. And I really look at the value of the house as an ancillary issue, and that's kind of the way I approach it. It's probably why I only have 2 properties.
Well,
But they've done
there's nothing
really
wrong
well,
with that,
and-
though.
Yeah.
Right? I mean, you've owned a house for 36 years. You've seen a couple market cycles in this rental
That's
properties
correct.
that you bought in
And
1984.
and you bought the one in 2008, and for a while you're probably thinking, dang it, I wish I would have waited. And now you look back and say, that was the right thing. People can have the same perspective on
yeah,
the stock market,
yeah.
by the way, right? You can always say, well, it's too high. But if you go over a long enough period of time, it's going to go up in value. Same thing with the real estate price.
Well, yeah, and that's so I mean the thing is my take on the real estate market is that it's so obscenely high. I don't see how a whole lot of people can continue to afford these. So I'm looking that we might see maybe like a 30% correction. I might be wrong. I may very well be wrong, but
I'm not that smart. I'm not that smart. I got to tell you,
I would be surprised if we had a 30% decline.
Yeah, last time I actually got on the air and said 40% in 07 on the air.
Because there was no fundamentals.
There was
underlying fundamentals.
But now it's different. It's different. It's much different. So the answer to your question is it a good idea to do that?
I mean, part of it with low rates. You know how many people are just like Craig? I've got all this cash in the bank earning nothing. I might as well go buy a rental.
Yep.
I mean, that increases the demand for homes right there.
Yeah, and the low cost of capital for first-time buyers and the incentive programs and all of that.
Interest rates are so
I have a son that's trying to buy a house, and he keeps getting outbid every time he turns around.
I know, and that's the problem. I mean, the thing is, I see something available, and I go take a look, and it's sold. So
that's a completely different issue. So either which way you go, you're going to be fine. Sometimes maybe patience, maybe just wait. It's okay to have money sitting on the sidelines, not doing anything for a short period of time. I'd be patient.
Okay.
That's what
that kind of sounds like good advice, because I'm just, the thing is, I'm working full time again, and I've got my rentals, and my rentals are both significantly positive in net.
One doesn't even have a mortgage.
Flow.
Yep.
And
I mean, if I were in your situation, I would probably approach it as I would buy a rental with cash and not take a mortgage on it, and bring my savings balance way down.
Yep.
Get a higher income on it and not have to worry about making a mortgage payment.
But I wouldn't be in a hurry to do it. I'd be patient. And I'm actually saying that out loud, not for you, but for me, because I have to tell myself that.
Be patient.
Be patient. Patience and persistence wins at the end of the game.
Yeah. But we have no idea where the real estate market's going to go in the next 24, 36 months. We have no idea where the stock market's going to go. I think if you go over a longer period of time, you'll see appreciation in both those areas, assuming the real estate's in the right place. And you could certainly point to examples in the United States where, had you owned a rental place there, it would have been a disaster, and had you owned it in other places, you would have looked like a genius.
Hence, diversified portfolios.
Yeah, so anyway, unfortunately, we're out of time. We broadcast every week at the same station, and of course, our program is available via podcast. And if you've enjoyed this program, we are glad you were with us. Feel free to pass it along to a friend. And enjoy the rest of your weekend. We'll see you next week. This has been Scott Hansen and Pat McLean of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.